Welcome to today's program titled Institutional Investor Insights, Liquidity Strategies for Limited Partners. At this time, all participants are in a listen-only mode. For those of you who are logged in to the web presentation, you are encouraged to submit questions through the conference by typing them into the Q&A box on the right-hand side of your screen. For those interested in obtaining CLE credit for this webinar, later in the presentation, we will read the CLE attendance verification code. Please write this code down as it will not be reread and is required on the CLE credit request form. During the program, you will see a slide with a QR code that you may scan to access and submit your request for CLE credit. You can also find a link to the form in the connection details email you received this morning. Copies of the webinar recording and materials will be distributed to all attendees in the days following the webinar. On the next slide, you will see a legal disclaimer. This presentation has been prepared by Seyfarth Shaw LLP for informational purposes only. The material discussed during this webinar should not be construed as legal advice or a legal opinion on any specific facts or circumstances. The content is intended for general information purposes only, and you are urged to consult a lawyer concerning your own situation and any specific legal questions you may have. At this time, I would like to turn it over to our first speaker for today's program, Matt Cohen. Matt, please go ahead.
Yes, welcome to our webinar. We are excited to discuss a few of the liquidity options that limited partners could face these days in the market. I'm a partner in the Institutional Investors Group in the Atlanta office, and I would like to introduce my colleague, Shamim.
Hi, everyone. My name is Shamim Mohandasi. I am an associate in our Institutional Investors Group, and I am practicing out of Seattle. It's good to be with you.
So on the agenda today, we really want to just give a brief introduction to the different solutions that we are now seeing in the market on a pretty frequent basis. First, the LP-led secondaries, then we want to discuss briefly about LP NAV lending and then collateralized fund obligations. But a little more importantly, we also want to talk about some of the best practices around these different solutions. So in terms of the strategies, LPs seek liquidity mainly to find an ability to rebalance their portfolio, comply with different policy guidelines, adjust to the macroeconomic conditions. There are different ways to really consider a particular fund or vintage or portfolio or asset class within your portfolio. Sometimes LPs require liquidity to fund future commitments in order to avoid losing allocations with sponsor strategies. There are just different ways in which to approach these solutions, some of which are, GP-led, but what we're focusing on right now are the ones in which the LPs could lead themselves. And the first being LP-led secondaries. So this is the tried and true manner in which a selling LP sells their interest in one or more funds to a buying LP, which may or may not already be in the same fund. And this really requires the buying LP to acquire the rights and obligations of the selling LP and to create a market between the seller and the buyer in order to determine the valuation. As a buying LP, there's more diligence in terms of the documents themselves. What are the rights and obligations of the selling LP? Who are the sponsors? What's their track record? Who's their senior management? Everything in which a normal LP going into a fund would want to diligence. As a selling LP, there's really not much diligence required. In the end, as a selling LP, you just want the right buying LP to just back up the truck of cash, so to speak. That said, a selling LP still has the obligation to at least go through whatever consent process is required within the documents of the fund, and to arrange and coordinate the selling LP to be admitted as a new LP. The secondary, LP-led secondaries are the classic way in which an LP can find a non-GP-led liquidity solution. And there are a number of benefits for particularly the buying LP. So in terms of the entry price to get into the fund, there's often an actual discount to the value of the selling LP's interest, which could potentially enhance the returns of the buyer. Unlike primary investments, secondaries are obviously, while the fund has already been running and still has life within its term, so it offers a bit more transparency into the current portfolio of the fund and the performance of the fund and what the potential pipeline will be to the investors. As a buyer, you're also going to have a shorter hold period with the fund already partially through its life cycle. The buyers aren't going to have the full length of the term of the fund to hold their investment. Buyers can also find diversity within participating in the secondary market. They could find exposure across different vintages, geographies, strategies, so forth. And then more, what may be more important for some LPs is that it offers them the ability to be, to gain allocation and to establish a relationship with a new manager they may not have already invested with, and they may not have had the ability to invest with them before in the past. So there's a sense of gaining access to a wider group of sponsors through the secondary practice. And
I think with that, we'll move on to LP NAV lending. If you could advance the slide, please. Thank you. So unlike a traditional LP-led secondary where an LP is actually liquidating their fund interest or interests, LP NAV lending, and we're distinguishing that from NAV lending more generally to funds, is almost identical to what fund level NAV lending looks like. It provides LPs with liquidity using pledged LP interests as collateral for the credit facility, and thereby allows them to access some level of liquidity, without liquidating their positions. Next slide, please. So why would an LP seek NAV financing in lieu of a traditional secondary? For a few different reasons. First and foremost, it may be an option when selling the interest in a particular fund is not entirely feasible, whether that's because of constraints, contractual constraints or performance constraints. If the LP interest or interests are not necessarily readily liquidatable on the market, then NAV lending may be an alternative. Second, in retaining the NAV liquidity in lieu of a secondary, an LP gets to maintain their relationship with a manager or sponsor and demonstrate ongoing confidence in a particular strategy. In many cases, in particular for smaller LPs, getting access to a particular sponsor's fund is a bit of an uphill battle in the first instance, and seeking to liquidate that interest may damage the relationship between the LP and the sponsor. And as a result, it may be appropriate for the LP to seek liquidity by means other than liquidation of the interest. Next, and perhaps most importantly, if an LP is in search of liquidity but remains bullish on a particular fund or family of funds that they have exposure to, by taking down a LP NAV facility, the LP gets to maintain the upside exposure in that fund. For example, and this is, I think, particularly relevant now, where many buyout and venture funds are holding assets, kind of midlife longer than would otherwise be expected. And that facility allows the LP to access some near-term liquidity, while perhaps an asset in a venture portfolio is expected to be liquidated at a very attractive price down the road. So you do maintain the upside exposure. And the other side of that coin is, unlike secondary liquidation, LPs don't necessarily need to accept a discount to their net asset value in borrowing against the LP interests, because it's not a liquidation. It's just a question of how much borrowing they can attract through these facilities. It is worth noting, however, that NAV facilities do not offer as much liquidity as perhaps a secondary transaction might. Based on our knowledge of the market, most NAV lenders are interested in lending about 15 to 35% of NAV of the pledge collateral. And so whether or not enough liquidity can be unlocked through NAV lending is a question that LPs need to ask themselves before they go too far down that road. Next slide, please. Finally, we're going to speak briefly to collateralized fund obligations. Collateralized fund obligations are a growing, not a new, but a growing tool for LPs to achieve liquidity. They are conceptually similar to a NAV facility, but offer much more opportunity for bespoke engineering of financial products to meet the needs of the LP seeking liquidity. And I'm sorry, Jess, if you could please advance the slide. A CFO is like a collateralized debt obligation, is a basket of LP interests that may have different features and characteristics, but when combined can be collateralized to backstop a variety of different obligations. And that may include some variable rate instruments, some fixed rate instruments, and then some term instruments. And the associated cash flow with different LP interests would essentially be underwritten to service different tranches of the CFO. The attractive feature of a CFO over a NAV facility is that because it is bespoke and because it is issued by the LP kind of on a primary basis, the LP may be able to achieve superior returns by engaging a more diverse lending base that would reduce cost of capital on the most on risk-adjusted paper as kind of up and down the risk stack. And so maybe a private lender would lend against one component of the CFO versus a commercial bank that might be willing to buy a different kind of safer tranche. Finally,
and Shamim, if I can jump in, one structure I've also seen that I've personally worked on as well is where the senior utmost tranche was actually a credit facility, and then the rate spread tranches were underneath that and were subordinated to the credit facility, which created a unique option for liquidity on top of the actual offering by the LP as well. So that's just one aspect to the structure that could be unique to the CFO process here.
Yeah, and I think further to that, and maybe kind of just to put a point on it, because we can commingle cash flow across these various interests, strategies, and vintages, there's a great deal of flexibility as it relates to how best to structure these CFOs, which I think can be both a gift and a curse. A gift in the sense that it likely optimizes outcomes for the issuing LP. However, unlike LP-led secondary or LP-level NAV facilities, CFOs are a much more significant undertaking that will require significantly more work in order to be consummated. I think with that we can move forward into where to start.
Yeah, so the first and foremost place of where to start is internally. So if your organization is looking to find liquidity solutions and you're not wanting to rely on a GP-led transaction, LP-led transactions really require the collaboration and coordination of different advisors to start. Although the LPs can kick off the process overall, the LP would want to have legal counsel, accounting, finance, tax, financial advisors, potentially investment bankers, to determine whether or not the transaction itself is going to be viable within the market. LPs may also want to discuss and have a deep consultation with the different sponsors that are involved or could be involved in the secondary transaction, depending upon what liquidity solution you're pursuing. That's going to be a key element as well, is to have that open conversation with the sponsor, and to also see if the sponsor may even be willing to help or in finding the right buyer as well in the transaction. Ultimately, an LP will need to at least consult the sponsor with respect to the actual legality of the transaction. As with most fund interests, the fund interests they're not able to be pledged towards any kind of transaction, liquidity transaction such as this. These transactions would fall under the commonly defined term transfer within the LPA or LLCA, and therefore would require going through the consent process and the diligence that the sponsor would have to do on the potential buyer in terms of being an eligible LP, that no securities laws would be violated, and that all the other different best procedures would be implemented as well. So there needs to be a conversation with the sponsor from the get-go. There needs to be conversations with the advisors that are part of the LP's team. It wouldn't hurt to bring in external counsel as well in order to help do some initial diligence on what fund or funds could be implicated in the transaction, and in order to determine, as I had mentioned before, that the transfer requirements and any AML KYC requirements that the sponsor may need to go through and comply with as part of their onboarding process. So that's where things need to start. It's just the conversation internally, externally with the sponsor. Once you do determine to go forward into one of these liquidity solutions, it then becomes a bigger business discussion in terms of the selection of the fund or funds, whether or not, where the risks are in, disposing of those interests versus holding the interests. While a lot of that diligence and determination analysis had been likely done before consultation with advisors and the sponsors, once it becomes real, so to speak, that conversation about the economics of it and the viability of it should continue. Another aspect to really think about is the fact that these transactions can take a while. A number of sponsors, for example, just do not allow transfers except on a quarterly basis. Plus, you have to factor in, obviously, the time it takes to find a buyer or to find a lender for an LP NAV or, an investment bank or a placement agent for a CFO. So these transactions can actually take quite a bit of time, which needs to be factored into the economic analysis as well of the transaction. These are not overnight transactions. And so that will also factor into the hold period of what's left on the transaction, on the fund interest as well. You might be interested in selling a fund interest that only has, a 4 years left on its term, but it's going to take a year, possibly up to a year, to even do the transaction in the first place. So what does that look like in terms of the economic analysis as well?
So I think to summarize a little bit of that, we view this process as being, obviously LP driven, and our first two stops in terms of stakeholders really end up being first a visit with counsel to review LPAs and consider what liquidity strategies may be available based on the LPAs, and thereafter likely a conversation with GPs and sponsors to explore whether anybody in their orbit, including other LPs in those same funds, is interested in picking up additional LP interests. After having those two conversations, then onboarding accounting and finance support, and if necessary, financial advisors or investment bankers to actually run a process becomes necessary. And again, as Matt mentioned, this process, these undertakings are time-consuming, but also often constrained by size of portfolio. So, for example, for a smaller investor with 100 million in LP interests that's looking for some kind of liquidity, we would not necessarily recommend exploring a CFO. That would be a kind of an overlarge undertaking. But some of the other solutions that we've discussed here briefly would be viable and would be achievable with a smaller team that can do this work. I think that'll take us to the next slide. Okay. Any questions?
I'm curious to know of the attendees out there who might be actually currently contemplating a liquidity solution as we speak, and if so, what you're finding in terms of the analysis that you're going through, and whether or not you've taken some of the steps we've suggested in terms of bringing in the various types of advisors.
Yeah. I mean, without putting anybody on the spot, Matt, I think, in particular, following the kind of news of Yale's large secondary sale earlier this year, I think interest has been piqued, generally speaking, on what's available. Whispers around what's actually achievable in terms of discounts to NAV, I think have inspired a little bit more interest in secondary transactions in particular, LP-led secondaries in particular. And then obviously, I think there's just a lot of pressure to seek liquidity in light of what's going on with funds who are extending terms and just avoiding liquidity events, given kind of a soft IPO market and slowed M&A activity. So whether or not any of our audience wants to volunteer any information, it's obvious, I think, from just general market reporting that the volume of LP-led secondaries in particular accounts for something like half of private equity secondaries in general, and is growing at a pretty decent clip. I think a few of the stats that I've seen suggest that LP-led secondaries in particular are growing about 40% year over year. Of course, it's private. That information is a little bit subject to prodding and correction, but there's a lot more activity in this space than there has been ever before, and it's been growing for a number of years. We're running about 15 minutes ahead of schedule. I think if there are no other questions, we can probably give folks a little bit of time back in their day. I think we have a CLE code for anybody who's interested.
CLE code for this webinar is SS, as in Seyfarth Shaw, 0884. Once again, the code is SS, as in Seyfarth Shaw, 0884.
Great. Well, thank you for joining us this afternoon, and please feel free to reach out if you have any questions or have any opportunities that we could assist with.